A very warm welcome to all of you to this session at Asian Investing Summit 2015. It's such a pleasure for us to have with us once again Chan Lee and Albert Yong, co-founders and managing partners of Petra Capital Management based in Korea. We've been fortunate to have the opportunity to sit down with Chan and Albert for an in-depth interview on value investing in Korea in the past, and also to have them present an idea at last year's Asian Investing Summit. Chan and Albert have a slide on that in their presentation. I really want to turn it over to them. Before I do so, just to let you know, Chan and Albert do have very extensive experience in investing and business in Korea. Prior to starting Petra Capital, Chan was an investment banker and corporate attorney for more than 10 years in Korea. Albert was managing director and chief investment officer of Pinnacle Investments, as well as vice president of Pan Asia Capital. Without further ado, I do want to turn it over to Chan and Albert for their presentation, and when they're finished, we will have a short Q&A session as well. And with that, Chan and Albert, please feel free to go ahead.
Thanks a lot for a kind introduction, John. Hello, my name is Chan Lee. I'm the co-founder and managing partner of Petra Capital Management. I'm very honored to be presenting today at the Asian Investing Summit 2015, together with my partner, Albert Yong. Our presentation title is called Capitalizing on Korea Discount. We'll take this opportunity to share our view that the Korean equity market currently offers compelling investment opportunities for international value investors. In particular, we will talk about the existence of so-called Korea discount in the Korean equity market and explain why we think this Korea discount is likely to get reduced in the near future. Here is the disclaimer from our lawyer. Before we begin our presentation, let me speak to you briefly about who we are. Petra is a Korean licensed investment management firm based in Seoul, Korea. We believe that we're one of the few fund managers in Korea that actually practice the true form of value investing, and we consider ourselves to be disciples of Benjamin Grant and Charlie Munger. At Petra, we constantly look for competitive, undervalued Korean public companies which are selling at a significant discount to intrinsic value. Our value strategy has worked well in Korea. Since our inception in September 2009, we have achieved an annualized return over 22%, whereas the Korean index returned only 3.4% annually during the same period. Last year at the Asian Investing Summit, we recommended Nexen Tire and also discussed a couple of alternative ways of purchasing Nexen Tire. As you can see in the graph, all Nexen Tire related stocks have done much better than the Kospi. In particular, Nexen, the holding company of Nexen Tire, is up 18% so far. We'll continue to hold Nexen Tire because we believe that this company is likely to do even better in 2015. Once again, I'd like to emphasize that value investing works very well in Korea, as Petra's investment record for 5.5 years is a testament to the power of value investing. Despite the lackluster performance by Kospi, Petra Korean value equity strategy has continued to deliver a steady return for its investors. We have a lot of information to cover in a short time today, and we'll be going very quickly with our slides. Basically, I'll cover the first part of the presentation, which is an overview of Korea and a discussion on Korea discount in the Korean stock market. In the second part, Albert will discuss two specific Korean equity ideas, which are based on our investment thesis of capitalizing on the Korean discount. Yes, we believe that Korea discount is not permanent and it's not here to stay for too long. Korea has gone through a truly remarkable transformation in 50 years, going from from one of the poorest countries in the world to one of the richest while transitioning into full democracy in such a short time. Only back in 1950s, Korea was as poor as Kenya, with GDP per capita less than $50 US. With GDP well over $1 trillion US, with foreign exchange reserves of more than 350 billion US, Korea is one of the wealthiest countries in the world. The total equity market cap of Korean companies is also well over $1 trillion US, which makes the Korea stock market to be the 13th largest in the world, similar to the size of German stock market and bigger than the stock market of Switzerland. The international investor community is finally beginning to notice Korea's fiscally sound government and economy. For example, S&P's Korea sovereign rating of A+ is higher than that of Japan and China. Here are some examples of champions from Korea that you are probably familiar with. Samsung Electronics, Hyundai Motor, Korean shipbuilders, and etc. In addition, unbeknownst to the Western world, Korean consumer products, such as cosmetic products, are hugely popular throughout Asia thanks to the recent success of Korean movies, dramas, and K-pop singers. Korea's success can be attributed to its human capital. Especially, Korea has one of the highest educated and hardest working labor force in the world. Here are some insightful comments from Warren Buffett, the greatest value investor of all time. Apparently, he likes what he sees in Korea, including the valuation of the market. This photo is taken during his second trip to Korea in 2011 when he said he was looking to buy big businesses in Korea. Despite all the positive developments in Korea, Korea is currently still one of the cheapest equity markets in the world. This chart here shows the PE and PB ratios of Korean stock market relative to other major markets. It's hard to believe that the valuation level of Korean stock market is less than half of Philippines. The Korean stock market was down close to 5% in 2014, while most of other major stock markets in the world performed quite well. In fact, Korea was the second worst performer after Russia among the OECD countries. What does this mean to value hunters? We can easily find many competitive Korean companies trading at discounts to book value with single-digit PE ratios. How cheap can it get in Korea? We can find numerous public companies in Korea which can be categorized as net companies, as defined by Benjamin Graham, the father of value investing. Net companies are those companies trading well below their liquidation value. Some examples are shown here. Some of these companies are actually trading below its net cash holding amount. Extremely cheap. Here are some reasons why we think Korea is difficult for international investors. There are only a few companies provide their disclosure reports in English. Many companies also often own several non-core business units and subsidiaries, which makes it complex for investors to value them. In addition, it's also very difficult to analyze qualitative aspects of Korean management team due to language barrier and cultural difference. We also note that many international value investors are skeptical about Korean companies because there are concerns on corporate governance and capital allocation. There are some truth to their worries, but I'll discuss these issues in more detail in next slides. We think that the biggest reason for Korea discount probably comes from the complex ownership structure. Many large Korean companies, especially chaebol, the Korean business conglomerates, have cross-holding structure, which makes it almost impossible to value companies. Also, many investors are rightfully concerned about transactions made between affiliate companies. Also, most of these Korean Jebber companies are run by family-controlled management. Some of them may be questionable in terms of their talent or ethics to operate large public corporations. Here are some pictures of those who had legal troubles in the past. The second reason for the Korea discount is probably from the investors' concern about capital allocation policy on Korean companies. Korean companies are notorious for not paying dividend despite accumulating large amount of cash from their success in business. In fact, Korean companies hold too much excess cash. This problem is similar to what you see in Japan. The amount of cash sitting on the Korean corporate balance sheet is well over 400 billion US dollars, representing over 30% of Korea's GDP. Yes, I think this could be a real concern for many investors. One prime example of such capital allocation issue was Hyundai Motors' recent purchase of a land in Gangnam in Seoul for $10 billion. Although we think that this matter is really about one company or one individual, Chairman Chung, rather than the general reflection of Korean corporations in general, it does create a real bad impression when the rest of the Korean business community is actually working hard to improve corporate governance. As you can see below, Hyundai Motor does have a lot of cash on their balance sheet, but they could have used $10 billion for many more useful things. Despite the recent Hyundai Motors fiasco, we like to argue that Korea is going through a steady and substantial progress in regulatory reforms and market practices that will result in more transparency and protection for minority shareholders. For example, the cross-holding structure is no longer allowed under Korean law, and Korean government is also very committed to cracking down on less than arm's length business transactions among affiliated companies. I also would like to point out that despite the image problem caused by Korean jabbers, corporate governance of small to mid-cap Korean companies is much better with a simpler ownership structure. They tend to focus on their core business and they're not too interested in building an empire. In respect of capital allocation and returning money to shareholders, we're also seeing a number of positive signs. Amid widespread recognition that Korean corporate capital allocation policies must improve, many of Korean companies are actually turning course to become more shareholder friendly. For example, Samsung Electronics recently bought back shares worth over $2 billion US, its first since 2007. Hyundai Motor also increased its dividend payouts by more than 50% in 2014. Total dividend paid out by public companies in Korea in year 2014 was $13 billion US. This is also an increase of about 30% from 2013. The government is also playing a role here, recently adopting two pieces of legislation that could be of great benefit to all shareholders. One substantially reduces the taxes on dividend payments, and the other effectively penalizes Korean corporations for holding excessive cash. We think that the Korean corporate governance and rule of law have improved significantly, resulting in a more favorable environment for shareholder activism. Korea is different from Japan in the sense that minority shareholder rights are very protected and Korean management teams are often receptive to shareholder overtures by foreign investors. Yes, we realize that there's still room to go, but we're definitely seeing significant improvement from the past. Therefore, we expect more activist investors and private equity buyers to take advantage of Korea discount, which is likely to reduce the market inefficiency you see in Korean market. In this regard, National Pension Service, NPS, Korea's largest equity investor, has recently amended its internal guidelines to become an active shareholder. Basically, they're modeling themselves after MBIM, the Norwegian pension fund, and their new stance is likely to have a profound effect on the Korean market participants. Now I think I'm at the end of first part of our presentation. I will turn it over to Arbor now, who will discuss our two equity ideas which are based on investment thesis on capitalizing Korea discount. Thank you so much.